So we are starting from chapter 13, the income tax. Mr. Good afternoon. So we are coming from chapter 13. That's the income tax. IAS 12. So we are looking at IAS 12 income tax. So we are going to go through our part page by page and discuss it. Then from there, we can move to our questions bank at the end of the topic or the chapter. So income tax. This taxation is one of the important when it comes to company. Company pay tax. That's what we call company income tax, CIT. And in paying tax, there's a need for us to compute the tax liability in line with tax rules in Nigeria. That's the other the Company Income Tax Act. So in order to compute the tax liability, we have to consider our financial statement at the end of the year. Because by the time you get your point of the year, we have to remove tax payment from it, and get profit after tax. Then in order to address the tax, the accounting standard that deals with that record detail IAS 12, that's the income tax. So we want to look at, but first thing, let's look at what the position of the tax law is saying. Tax law, taxation of profit. Taxation of profit. Taxation of profit. Companies pay tax on their profit. That was the page. I'm reading now from page 297. Page 297. Page 297. Companies pay tax on their profit. The tax charge is based on the accounting profit as adjusted according to the tax law in Nigeria. The tax is payable in according to the tax law in Nigeria. Definition. Accounting profit is a profit or loss for a period before deducting tax expenses. Now, when you prepare your financial statements, your profit or loss after you have gotten your revenue, normal in your normal format, our revenue, when you put your revenue here, you say less cost of sales, you do your cost of sales, you get your gross profit, am I correct? Then you build in your administrative expenses, you remove your expenses, then distribution cost, am I correct? You remove it, then you have your finance costs. You remove your finance cost, then you get your profit before tax. Now, this is the profit that we are referring to. But this profit is accounting profit. You have arrived this profit following all the rules and regulations in line with the financial statement, in line with the International Reporting Standard or IAS, anyway you are talking about. Now, when you want to compute, normally you now say, what do you do next? Remove tax. When you are computing this tax, you have to do something about this accounting profits by adjusting it to taxable profits in line with the tax rules in place in your jurisdiction. That's what we are saying now. This profit is a profit that we are going to tax after you have adjusted it in line with the tax rule. Let me read that again. Company pay tax on their profit. The tax charge is based on their accounting profit as what? Adjusted according to the tax law of Nigeria. So we don't just pick this profit here and tax it away. No, you have to adjust it in line with what? With the tax law of the country. Then definitions now. What is accounting profit? There are difference between accounting profit, taxable profit. Are you together? So what is accounting profit? Accounting profit is a profit or loss for a period before deducting what? Tax expenses. This profit here, this is what we call accounting profit. This is the profit before you have deducted what? Tax expenses, because there are some expenses that in line with the tax law, they are allowed. While some expenses in line with tax law, they are not allowed. So your accounting profit is a profit for the period before deducting tax expenses. Then, what is taxable profit? Taxable profit or loss is a profit or loss for a period determined in accordance with the rules established by taxation authority upon which income tax are payable or recoverable. Now, please, let me quickly summarize again. We have accounting profit, we have what? Taxable profit. This accounting profit is a profit you compute in line with your international financial reporting standard or IAS, International Accounting Standard. That is, once you prepare your account financial statement, that's the profit you are getting is what we call accounting profit. But this profit is not what you are going to tax directly. You must have done one or two adjustments on it. By adjusting them, you have what we call taxable profit. So by the time you adjust accounting profits, it will become what? Taxable profit. That is what taxable profit is all about. So it's a profit that is computed in line with the tax law in your jurisdiction. That's what we call taxable profit. Then, what is current tax? Current tax is the amount of income tax payable or recoverable in respect of taxable profit or tax loss for a period. That is, by the time you apply your tax rate on this taxable profit, what do you have? You have what? Tax what? Current tax. So it is the rate of tax applicable to taxable profit that gives you what we call current tax liability. Because either it is payable or if it is a loss, then that you don't pay any tax. The question now is how do we compute tax? Tax computation. Please, I've said it down. When you have fraud before tax, this is not the figure that you tax. No. There's a way to compute tax liability in line with the company income tax in Nigeria law. So let's see how we compute tax. A series of adjustments is made against a company accounting profit to arrive at its what? Taxable profit. There is a series of adjustments. You have to adjust these profits. Accounting profit, you have to adjust it to become what? Taxable profit. Before you what? You actually compute your tax. Then, this adjustment involves when you are computing your taxable profit, that is your adjusted profit. Let's use that language now. Adjusted profit. The first thing that comes to your mind is to get your accounting profit. That is the profit that you are bringing in from your financial statement. That is for your profit or loss account. You bring this because that's accounting profit. That's your profit before tax. That's our profit before tax. You bring that profit to this computation. The next thing you have to consider, there are some expenses that in line with accounting standards, they are allowable to be deducted as expenses. But if the same expenses coming to law of tax, they are not allowed. So such kind of expenses, you must be able to identify them. Those expenses that are not allowed in line with tax law in your jurisdiction. So that's some expenses you add it back. That's what they are saying now. Number one statement. Add back inadmissible expenses. The deduction. Accounting expenses which are not allowed as a deduction against taxable profit. So what we have to do first, we add back non-allowable expenses. Non-allowable expenses. So it's not left for you to be able to identify those expenses that are not allowed in line with laws of tax in Nigeria. From our previous knowledge, what are the samples of expenses that is not allowed? Depreciation. But people your time of depreciation. I mean, depreciation is not allowed. These are expenses that in accounting law you allow it, abi, but when it come to tax, you must not allow it. So depreciation you can't allow. The other expense that is not allowed. Donation to non-approved body. Donations to, because in tax law there are some body that you can donate to that are under the fee schedule of tax law that you can donate to. So those donations to non-approved body is not allowed. So donation to non-approved body. So you add this. Okay. Aside donations, other expenses. Miriam, you don't forget. Tax. Now general provisions. Because in accounting, we allow provisions, right, Abi? But when it comes to issue of tax separate distinguish between specific provision and general provision. So specific provision will be allowed in tax law, but general provision will not be allowed. So general provision will not be allowed. General provision. Okay. Another one, there are many fines, penalty and fines. Fines and penalties. They are not allowed. Okay. Then any expenses that is not wholly, reasonably, exclusively, and necessarily incurred for the purpose of generating income, they are not allowed. Expenses that is not rent, abi, wholly, reasonable, exclusively, and necessary. That is not rent now. It's not allowed. So there are many. As you are reading your manual, you will see them more. So such expenses like this that fall in this category, you have to cut it back to this expense. That's the first thing you have to adjust for. Number two, that you must adjust for deducting unreasonable expenses, which include expenses that are allowed as a deduction against tangible profit, but which have not been recognized in financial statement. What I say this? There are some expenses so that automatically they are allowed, but when accountant was doing his job, he omitted them or he forget to want to remove them. So such expenses that we do now, you come and so the last say the less after you have asked back, next month is what you less or deduct allowable expenses omitted. Then okay, before let me complete the chart. After you've added this, then you also add back taxable income omitted. Let me complete that. I'll complete all the addition first. They add taxable income omitted. There are some income that they are taxable. The income is taxable, but when accountant was calculating his own revenue, and honestly, you miss it. There's such expense, such income. What do? You hide it back. Do you get my message? This income is an income. It is taxable. But when he was preparing his account, in the revenue, he omitted it. No, the moment you omitted it, you omit it here. What happened to your profit is reduced, right? So what do you do now? You add back such income. The after you have done that, then you now say less allowable expenses omitted. So that some expenses they are allowed, but by the time they are preparing the account here, mistakenly it was omitted. There are expenses omitted. The expenses that is omitted, so the expenses that is allowed is I know that are reasonable, necessarily, exclusively, and wholly for the purpose of generating the, and there are so many expenses, salaries and wages is allowed, rent is allowed, repair is allowed, repair and material is allowed, donation to approved body is allowed, pension contribution is allowed. So these are the life expenses in line with the tax of the still go to that later. Then also you also less non-taxable income. There are some income, according to tax law, they are not taxable. They are not taxable. Look at one example of that. Dividend. Is it that dividend is not taxable? Dividend is taxable, but we treat it as a frank investment income. Dividend is we pay withholding tax. Please don't make that mistake. Dividend is taxable, but we treat it as a frank investment income. That is, we have suffered tax once, we must not suffer another tax again. That's why we always remove it. Although we classify it as a frank investment income, that's the dividend. But we don't. What I'm trying to correct is that it's not that dividend is not taxable. It's taxable, but we only pay with only tax on it, and it's a final tax. Then what of sales on disposal? Sales on disposal of assets. That's gain on disposal of assets. Of the assets. Then is all this income will be added together. Then to add this, and then you subtract everything, you get what we call adjusted for. What is that? That's what I want. So this is the profit now that can now be subject to tax. So in line with tax law, you have to move your accounting profits, you have to move them to what? To adjusted profit by follow all these laid down principles that we have discussed so far. So if you look at the format in our table, the tax rate is applied to the taxable profit to calculate how much a company owes in tax for the period. IAS describe this as a current tax. By the time we apply tax rates on these profits, we have what we call current tax. But don't forget, you have to come out, you have to also there will be very small. You have to remove your capital allowance from it. You have to adjust your loss relief for the bill, penalty charge, and the stuff to get your assessable profit. But we will talk about one later. So after that, you can see the table now. Accounting profit for before tax, add back inadmissible expenses, less admin expenses, profit before tax, taxable profit, tax rate, and the tax payable, that is the current tax. Then tax computation. Let's look at this example to address what you have just said on the board. Tax computation. I'm reading from page 298 now. Example, tax computation. Any good trader had an accounting profit of 789,000. Are we together, please? Okay, 789,000 for the year ended 31st December 2008. The accounting profit was after depreciation of 70,000 and included a profit on disposal, that is capital gain of 97,000. That's the accounting profit now. It's after you have deducted 70,000 naira as depreciation, and it also include profit on disposal, that is of an asset. Is profit on disposal of an asset taxable? Is it taxable? No. Is it non-taxable income? Is it non-taxable income? Then the company had an incurred borrowing cost of 70,000 naira in the year of which 10,000 naira will be capitalized in account. That was the IAS 23. When you have a borrowing cost and out of it has been capitalized, such capitalization expense should not be what? Should not be expense. Should be added as part of the cost of that. So that is not liable expenses. Number 3, the company held a right of use assets, that is a lease, IFRS 16. During the year, lease finance charge was 50,000 naira and rental paid was 80,000 naira. As of January 28, the tax system value of machine was 120,000 naira and for building was 600,000 naira. Tax regime, that is the tax law in that jurisdiction. All borrowing costs are deductible for tax purpose. Hello? In this jurisdiction, not like capitalization of borrowing costs. That is, all borrowing costs should be what? Should be capitalized. Are we together? Yes. Next line. Capital gain are not taxable. That is, anything like capital gain should not be taxable in that jurisdiction. Number 4, fines are not tax deductible. Fines are not tax deductible. Then accounting depreciation is not liable for tax purpose. Accounting depreciation is not what? Liable for tax purpose. Capital allowance are claimable at 10% per annum for building and 15% per annum for machinery applied to tax return value at the start of each year. Tax is paid at what? 30%. You are required to compute the current tax for the period. What I want to do is that we just want to apply these rules of computing tax. But I think that question is omitting something. Include your question if you have the hard copy. The question is not complete. In the question, there is a fine. You have to include fine to the question somewhere. Include fine somewhere. Fine paid in the year is 125,000. Include somewhere in the question. Because if it does not include fine, are you there? Fine Then 125,000. Fine paid is 125,000. Then okay, I think that's the only one that is not inclusive. That's the reason I read. Yeah, let's try to complete now. So computation of current tax. So we are starting from our profit before tax, profit before taxation. From the question, how much was our profit before tax for the period? They said any good trader had an accounting profit of 789,000. Are we together, please? 789,000. So if that one is 789,000, 789,000, then we have to add back. That is non-allowable expenses. Non-allowable expense, that or you call it non-admissible expenses, anyway you call it. Now, from the question now, let's try to identify those expenses that are not allowed. One, depreciation here. You want to pay the accounting profit was after depreciation of how much? 70,000. So such depreciation is not allowed, so we have to add it up. But one is depreciation. Depreciation. How much is it? 70,000. Okay, that one's okay like that. Then from the question again, I've identified it fine for us, Abi. How much was the fine page? I've identified 125,000. So fine page, define page 125,000. Then we were told that we were told that for the lease, the company had incurable cost of how much? 70,000 in the year, of which 10,000 have been capitalized in according to what? IAS 23. If the 12,000 has been capitalized, and we were told that all borrowing costs have to be deductible. The meaning is that if you have incurred 70,000 as finance cost, if 10,000 has been capitalized, that means they have only allowed 60,000. That means they capitalize 10,000. It remains 10,000 that has not been removed. And according to the tax code, that is area, not like capitalization of borrowing costs. All borrowing costs should be what? Should be expense. That means you have to go and less. That means a expense that is allowed. When we get there, we adjust that. Then if you go back down again, a company owns a right to use an asset. During the year, the lease finance charge was about 50,000, and the rental pay was how much? 80,000. Are we together? But if you go down to the information number 4 or 5, lease rental are deductible in full for what? For tax purpose. Now, this question is treating this lease like a finance lease. And you know, when you have a finance lease, you expense the interest rates during the lease, which is finance cost. And the rental payment will be taken to liability. But here now they say all the rentals should be expensed. That means the finance cost that we have explained before, what do? We add it back. So we have to add back the finance cost, the finance charge of the lease. Finance charge on the lease. How much was it? 15,000 the question, Abi. Now, please let me add these three together. Let's now go to the less allowed expenses. Allowable expenses omitted. Number one is the borrowing cost. Because we are told out of borrowing cost of 70,000, we have expensed 6,000. We have expensed 60,000. Remaining 10,000 was capitalized. But we have been told now that should be what? All should be capitalized. So all should be expensed. So therefore, that 10,000, what do we do now? We remove it as the expenses. 10,000, that's number one. Then we are told that all rental payments to be what? To be expensed. Abi, that was the reason why we add back 15. Abi, now the remaining one, what do we do now? We expense it. So rental payment, rental payment. How is it? 80,000. Then the income not allowed, which is a disposal of an asset. How was the gain on it? We are told that that second paragraph. It includes a profit on disposal of how much? 97,000. So it's an income that is not taxable. So I said that what will be with less non-taxable income. That's a profit gain on disposal. How much is it? 97,000. So all this income should be, all these items we have to subtract now. We have 70 plus 1.5 plus 15. What do we have? 210. This 210, we add it back. Then 10,000 plus 80, 90 plus have a 187,000. Am I correct? Yes. 187,000. So by now, our taxable profit should now be this plus this minus this. What do we have? That will be our adjusted profit. Our adjusted profit is 812. Abi? Our adjusted profit is 8 what? 812. Abi? 812. Now, we cannot stop here because out of last law, there are some 3 to 4 adjustments that we have to bring in, like a loss relief, balancing charge, investment allowance. Then you have to adjust for those who define the less loss relief. We remove it normally. Balance charge. We add it normally. Then we have investment allowance. We remove it. Then you have 812,000. The next one is our capital allowance. That's what we call in accounting, we call it taxable depreciation. That's capital allowance. That's taxable depreciation. Because depreciation, normal depreciation in line with the IAS 16 is not allowed. That was what we had back here. But we allow taxable depreciation. It's an allowance that we give in lieu of depreciation. So what happens now? And for the question, we have to be told that our accounting depreciation is not allowed, but capital allowance is claimable. How many percent? 10% per annum on what? On building. So let's go for building now. For the building, 10% of that written down value for building. The target value of machine is 120. For building 600,000. That we are express. Next up, my dear, 60,000. That's 60,000. Then for the machine, 18,000. So by the time we put them together, that was 78,000. So what do? We subtract here, then we have our accessible profits. So that's the profit that we have. That we have 734,000. 734,000. So our tax rate on it now, our current tax now, our current tax is 30% of 37,34,000. The other way up. 220,000. That's our tax, current tax for the year. So that is the simple way of computing tax. So this is the tax that we charge to our. So in case you have to compute EDT, your EDT will be 2% of your taxable profit. Let's do it together. Let's get 2% of this figure. That will be our EDT. That's our additional tax. 2% of 812.
But now it's 3%.
Yes, based on the new law. 3%. But we are still doing, we are not doing tax yet, we are doing CR. But normally now, based on the new law, is 2%. So 2% of 8, 1. Don't forget, if it is 2% of actual profit, or not on the it should be tangible profit, sorry. Tangible profit. So this one is actual profit. So that's 2% of 812,000. Now we have 16,240. So our total tax plus 220,200.
That's 236.
236. 440. Okay? That will be our total current tax for the period. So that's the amount we are going to charge to our company income tax for the year. So that is a simple way to compute tax. Let's go further a little bit now. We are trying to address IAS 2, income tax. So income tax give us some basic definitions. Give us some basic definitions that we have to take home with. Let's try to look at this definition one after the other. Tax base. Tax base. Are we there? I'm now reading from page 299. Tax base from our part. Tax base. Tax base. The above example refer.
Addition of that current tax on EDT.
Yes.
It's called what?
Total tax. Now that's our current tax. Our current tax payable. That's how much we are expected to pay for the period. Okay, tax base. The above example referred to the taxed down value of the machinery and building. This is the tax authority view on the carrying amount on the asset measure as a cost less capital allowance calculated according to tax law. IAS use this term tax base to refer to the asset or liability measure according to tax rule. Now, when you hear the word tax base, it is the measurement of your assets or liability in accordance with the tax rules. In accounting, when you have carry amounts, what does that signify? What is the carry amount in IAS 16? That's the cost of the asset minus accumulated depreciation and impairment loss hidden. Now, this tax base also is the cost of the asset minus accumulated capital allowance. Hello, are we together? So this one is cost minus accumulated depreciation that we refer to as what? Carry amount. But from the angle of tax, it will be the cost of the asset minus the accumulated capital allowance. So tax base is the measure of review of the tax law by comparing the carry amount of the asset rather minus the accumulated capital allowance. That's tax. So it should be measured from the angle of tax of it can be say asset or liabilities from the angle of the view of the tax law. That's what tax is all about. Then definition now. Definition in full now. Tax base of an asset or liability is the amount attributable to that asset or liability for what? For tax purpose. The amount attributable to that asset or liability for the purpose of what? Of tax. That's what we call tax base. So in mathematically, is the cost of the asset minus what? Accumulated capital allowance. That's the tax base. Then the tax base of an asset is the amount that the tax authority will allow as deductions in what? In the future. Because when you have an asset, that asset is allowable. That asset is allowable. Are you stop? That asset is allowable for deductions. But the only portion that will be allowable for deduction in the future is what? Is the tax base of it. That is, after you have removed capital for this year, the minimum will be allowed in the future. But after you remove that allowance again, the minimum will start until it becomes what? 0. That's what tax base is. Then measurement. Current tax liability assets for the current or prior period must be measured at the amount expected to be paid to recover from the taxation authority using the tax rates and the tax law that have been enabled or substantively enacted by the end of the reporting period. You must do the tax rate that is available as at the end of that reporting. For example, now, by the end of this year now, for the reporting period, all companies will be using 3% as their as their EDT. Because the law was enacted this year, the 3% was enacted this year. So by the end of this year, the law in place is 3% of an EDT as against 2% or 2.5% in the earlier year. So that's what we do like. So you have to measure it based on the tax law. Over estimate and underestimate of tax from the previous years. Now we want to now come to account. Let me say something like this. When you are preparing your financial statement, your profit or loss, you prepare accounts by December, abi? Or not before February. Accountant would have finished his job. Accountant want to submit the report for that year immediately, abi? He may not be able to wait for a tax consultant to come and compute tax stability. Okay, because if your profit is here, like this one now, 789, you cannot compute tax on this figure, abi? But as an accountant, you need to report something in your record here as well tax liability for that tax expenses. So instantly, you can quickly make estimate. Am I talking?
Yes.
You can quickly make estimate for that period and put it here, and you complete your account. Then after some months, maybe around March, that will not come. You will not complete the tax stability, but by that time you have already done with your financial statement, you submit already. So that will not come. You will not compute based on this law. You will not compute it. Oh, you estimate 200 here. Your tax should have been what? 236. And this is what you will pay by June when you when the tax year is 1 year. You pay that one by June. So okay, already the account for last year you have reported 200. I mean, but at the amount you pay for the period was what? 236. By the time you want to pay account for next year, your cash book will not be balanced. I mean, because your expense was 200. Your cash payment was what? 2,000. That means you have paid more than what you have what? Estimate. So by the next accounting year, you have to adjust for that estimate that you have made last year. Last year can be overestimate or underestimate. So by this year now, you must make an adjustment for that before you continue for tax ability for that year. That's what we look at now. Overestimate and what? Underestimate from the prior year. Let's see how we do that in accounting. Overestimate or underestimate of tax from the previous years. Current tax for the current and prior period must be recognized as a liability until paid. Until what? Until paid. If the amount already paid exceeds the amount due, the excess must be recognized as what? As an asset. Look at that statement again. If the amount already paid exceeds the amount due, the excess must be recognized as an asset. When the financial statement is prepared, the tax charge on the profits for the year is likely to be an estimate. Can you see now? By the time you prepare for financial statement, the tax charge are likely to be what? To be estimates. And that's an estimate. Estimate will not give you the actual figure about which we are now. So when the financial statements are prepared, the tax charge on the profit for the year is likely to be an estimate. The figure for the tax on profit in the statement of comprehensive income is therefore not the amount of tax that will be eventually be payable because it is only an estimate. The actual tax charge agreed with the tax authority some time later. Can you see now? After a few months, the tax you have now agreed, like what I just done now, the tax you now agree with them, which is this, is what you now pay. So in view of that, it's likely to be different. In these circumstances, the tax charge for the year is adjusted for any underestimate or overestimate in what? In the previous years. Then, what do you mean by, now let me now say this. What do you mean by overestimate or underestimate? Let me quickly address that. In 2019, you prepare accounts like this. Your profit before tax is this. You now say, okay, tax expenses, we are going to pay, let's say, 200,000. This is what you put in your account, abi? And this is what goes to your liability, your financial position. Am I communicating now? Now, by the time, maybe later in the month, maybe you have that account December, you finalize it like this, by February, January, February, March, your authority complete your accountability, you now arrive at 236. Abi? How much do you estimate?
200.
How much do you not pay? That means you are underestimate for that tax. You are paying underestimate. When the amount you estimate is actually now less than what you actually pay for the period, that will call underestimate. Are we together? But on the other way around, if what you have here is 250,000, and by the time you now compute tax liability, you now have what? 236,440. That you have what? You have overestimate your tax for the period. Then, if it's under, so by the time you now want to prepare for 2020 account now, by the time you want to prepare 2020 account, this 2019 abi, 20 don't forget that this amount, what are you going to pay it? You are paying it during the year 2020. Abi? This is the account for 2019 December, abi? You estimate it, but you will pay this tax until 2020. That way you are going to pay the tax, abi? Preceding year basis. That way you are going to pay the tax. Now, you already have the ability of 230. Open the ability, tax the ability. Then you now pay cash of 230. That account will not balance now. Am I communicating?
Yes.
That account will not balance. Let me show it again. If you have a ledger like this, by end of this year, you have a ledger tax balance, tax payable. Abi, you have 230. Abi now. So by around June, you now pay 230. What do? You credit cash, abi? You credit cash. Then you debit your tax payable, abi? Now put it there. 236, 440. That's cash. Does that account balance? You balance. So, but what by the time you want to pay account for 220 now, your account will not balance if you don't adjust for this over estimate that you have made last year. So before you come into this year now, you have to make adjustment for that over estimate. So how do you adopt it? How do you adjust for it now? In these circumstances, is that charge for the year is adjusted for under estimate or over estimate of tax in the previous year. Under estimate of tax of previous years profit is added to tax charge for what? For the current year. For you to balance this ledger here, for you to balance this ledger now, any tax that you have estimated for this year by you have done your own account. Okay, our current tax for this year is 210 now. So last year you estimated 230, how much did you do? 236. That's under, that difference. What is difference? So you have to put it there under estimates. Clear me? 440. What do you do? By that, we merge add now, and then you account what? To balance for that current year. So that's what it says. Say, under estimate of tax of previous year is added to tax charge for the current year. But if it's over, what do? You subtract. You subtract from this page. It's over. Under, we do what? We add. Over, what do? And I believe you know the difference between under and over. Under means that what you charge in your account is less than what you are paid. Like under. But what you charge, if it is more than what you pay, is what we call over estimate. So, an overestimate of tax on the previous year profit is deducted from the tax charge for the current year. That's what we call over. Now look at this example now. From overestimate or underestimate of tax. Profit from operation 460,000. Interest 60,000. Profit before tax 400,000. Adjustment for underestimate tax in the previous year 3,000. Then tax for the current year is a 100,000. What is total now? Wow, what are we adding? We are adding under estimate that due to the current tax because what 103,000. But if it's over, what do we do? We subtract from the current tax. That's now this. There are two. Let me quickly say something about tax. For the purpose of accounting, for the purpose of financial statements, for the purpose of profits or loss account, the current tax are posted to profits or loss. The tax expenses that go to your profit or loss is computed in this summary. You have your what? Current tax, like this. Or let me say tax expenses for the year, tax expenses for the year, like this. Then you now say your adjustments for over estimates and under estimates. Now, if you were to be over, what do we do? We deduct. If you were to be under, what do we do? So what you have here, that is your current tax that you post to your profit or loss account. Am I communicating now? We need to manage your by get tax expense and put your this. That is. But the figure that we put to your financial statement, okay, if the tax has not been paid, where do we take it to? You take it to financial current liability, abi? That as tax payable. So the figure that will show in your financial statement now as tax payable. It will not be like this. It will be for the purpose of the financial position now. Tax liability. In financial position. Is like this. Your current tax, this one. Well, let me start from opening tax liability. Opening tax liability. That's it. The figure you have here as opening liability like this. Are we together? You will now add this, the current tax. So with this current tax now, how do you get it? Your tax is paid for the year. Adjustment for overestimate and underestimate, you have it like this. So then add current tax. You add it. Then you have the figure here. Then the actual tax paid during the year. Tax paid during the year. The tax paid during the year. Tax payments. Or tax paid during the year. What do you do? Less. What you up? Then whatever you have in less, it's your tax bill. That's the tax bill. So this is the figure that goes to your financial position by the end of the year. Altogether, your tax stability, the amount that you have in your ledger and at the beginning of the year, you will add the current tax liability to it, then you add less the amount paid during the year, then you get your tax payable by the end of the year. That's what this figure that goes to your financial position And this is the figure that go to your profit or loss account for the year. Hope you are together, please. Okay, that's how you compute your tax liability. Okay, let's look at this example to practice it. Page 301. Page 301. Page 301. Page 301. Taxation in the financial statement. Fresh company has a financial statement year end on 34 December as at 31 December 2007. It had a liability for income tax 77,000. That's our opening tax liability. That's at by the end of the last year. If I'm to use ledger now, if I'm to use ledger, I will say if I'm to use ledger now. If I'm to use ledger, I will say tax payable. Like tax payable. I will say balance brought down or brought forward or brought down. You need 77,000. Have you? Okay. Now during the year, we were told that the tax on profit for the year 34 December 2008 was 114. Abi? That's our tax expense for the year. The tax charge for the year 34 December 2007 was overestimated by how much? 50,000. So that means we have to get our tax, our current tax, current tax expenses. And to get our current tax, what do we do? Is our tax expense for the year adjustment for over or underestimate. In this case, what do we have? It's overestimate. So we have our tax expenses for the year. Tax expenses for the year. You look at 114,000. Then adjustments for overestimate. When you have overestimate, what do we do? We deduct. So let's overestimate. How much overestimate? 16,000. What do we do? We remove. What do we have? 6,000. Thank you. 6,000. We have 114,000 minus 6,000. 108,000. 108,000. So that's our current tax. So this current tax, what do? You put it to credit side of your ledger. That's our current tax. How much? 108,000. Then the amount paid. So what do we do with this figure? You go to your profit or loss account, you expend this, then you create a liability for it for your 108,000. Then during the period, how much do we pay? During the year 31 December 2008, the company made payment of how much? 123,000 in income tax. What do? You debit your tax payable, you credit your cash. The cash paid, the tax paid. How much do we pay as tax? 123,000. So with view of this, what will be our balance figure? Where balance? 77 plus 108, that will be 185,000 minus 123,000. 185,000. Our balance 62,000. So our balance brought down is 62. So the figure that goes for the acquisition is what? This table will only have it. This ledger form, this is straight line. If I want to do it like this, I will say opening tax liability, opening tax liability. How much? 77,000. Then add current tax. Add current tax. How much? 108,000. What do we have? We have 185,000. Then we say less tax paid during the period. How much do we pay? We pay 123,000. What do we have? We have 62. That's our tax liability. Tax paid for the year. Sorry, our tax liability by the end of the year. So this is the figure I go to financial position, abi. This is people that go to where? Pure head. So 108 go to pure head, while 62,000 go to financial position by the end of the year. So this is how we address our income tax in line with the IAS 12 related to the company income tax. So let's go straight down to what we understand by deferred tax. By deferred tax. Deferred tax, income tax, deferred tax. When we are computing tax liability, by the time we want to consider the IAS 12 in question, then there's a word we call deferred taxation. Underlying problem of deferred tax. I want to get down to the page 3029 of our pack. Please, let's open it and go to the page. As explained in last section, in most jurisdictions, the rule for recognition and measurement of certain assets, liability, income, and expenses for tax purposes differ from equivalent rules under IFRS. Yes, because there are some expenses that if you allow in line with IFRS, we have IFRS and we have a tax law as rules. There are some income, there are some assets, expenses, liability, and okay, let me focus asset, expense, income, and the income. Now, even this element that we have here, the way we recognize them in line with IFRS are differ in line with what tax rules. That means when an accountant is preparing his own record, he will be using the rules of IFRS, but the tax law will be considering the rules of what of tax laws and rules. As well of that, your tax position in line with accounting will be different from your tax position in line with tax law. Are we together, please? Yes. Now, this results in different figures in financial statements and in tax computation, tax working paper. It is convenient to envisage two separate sets of accounting. Yes. When you are dealing with tax law, you should be looking from the two aspects of law. The accounting prepare in line with what IFRS rules, and the second set following the tax rules or tax computation. Can you see now? So when you are dealing with accounts, for the purpose of tax, we are looking from two perspectives, sir. One from the tax law and one from the accounting rules. This is IFRS or IAS. This rules is breaking down in the rates in the tax rate percentage relationship between the profit before tax figure and the taxation figures. In other words, the tax charge is not the tax rate applied to the profit before tax. Deferred taxation, underlying problem. Let's look at this page now and look at the underlying problem that we're trying to envisage. Estimated made accounting profit before tax of how much? 50,000 in each of the years 21, 20x2, and 20x3, and pays tax at 1%, 30%. Estimated bought an item of plants on 1st January 2001 for 9,000 naira. This asset is to be depreciated on a straight line basis over how many years? 3 years. Accounting depreciation is not allowed as tax deduction in tax division in which the company operates. Instead, capital allowance are available as shown in the following tax computation. Now, what we are trying to say here is this: if we are to consider tax, and we are to consider accounting. Accounting we consider depreciation, abi, but tax we consider what? Capital allowance. Now, if we are to depreciate this asset, we buy the asset for how much? 9,000 abi, and from based on the records, we are to depreciate for how many years?
3 years.
That would be straight line, abi. That means our annual depreciation